Hello there everyone, today's video is all about a wealth creation strategy. So how should you go about accumulating wealth? Well, the bottom line is that you need to do it in the most tax efficient manner. So there's no point in having your wealth accumulated in one area where there is no tax relief at the expense of having nothing in another area where you get full tax relief. So it's about mitigating investment risks but maximizing use of tax efficient wrappers. So what do we mean by that? Well, let's take a look. Assume you've got a husband and wife and they are director shareholders of a limited company. So tax and wealth planning for a couple, always try and max out your ISA. So remember, ISAs, £20,000 a year, money that goes in. Once it's in the ISA wrapper, it's free of tax. There's no tax on the growth, no tax on the investment yield, and it's tax-free to access when you take it out. So strategy point number one, always try and max your ISA. Husband and wife, two lots of 20 grand, that's 40 grand a year. Okay, next, pension contributions. Always try and max out your pension contributions. So again, husband and wife, 40 grand each a year. So £40,000 that you would, in this case, you would have a contribution from a limited company into the pension fund, because assuming they are paying themselves in a tax efficient manner as director shareholders, chances are there's very little income tax. If they're paying themselves 50 grand a year, £100,000 a year combined, via minimal salary and maximum dividend, the tax leakage on that is only about 5%. So they haven't got a tax problem from an income tax point of view, but hopefully they've got a profitable limited company and they're looking to do some tax planning in the company. So putting the pensions from the company into the individual pot will trigger corporation tax relief. £80,000 going from the company knocks 80,000 off the taxable profits of the company, which saves 15 grand of corporation tax. And then the money goes into pensions. And I've done numerous videos on pensions, but it grows free of tax. Again, as with an ISA, tax-free yields and tax-free growth. So that is number two options in the strategy, the wealth creation strategy. Number two, max out your pension contributions. So there is no limit to how much you can have in ISAs over a lifetime. So in fact, the ISAs have been in about a couple of decades now, or the ISAs that were labeled something else before that, but basically the family of tax efficient wrappers known as ISAs have been around for a couple of decades, and there have been headlines of so-called ISA millionaires who people have just put in their annual allowance. It never was even anywhere near as high as 20 grand, but over time, thanks to investment returns, they've become millionaires just within their ISA alone. So then we move on to the pensions. The pensions is capped. I've done separate videos on this in terms of this £1 million allowance that you have, so-called lifetime allowance. And if you bust that cap, then you start getting hit for tax. But £1 million is a big chunk of change to save via a pension. And most people in the UK, the vast majority of the people, will not have a problem of exceeding the lifetime allowance. So husband and wife, remember, they have £1 million each. That's £2 million. So that they can have £2 million in their pension pot before they've got any other worries about excess taxes. So strategy, the wealth creation strategy, max the ISA, max the pension, but obviously you don't want to go beyond the £2 million per couple. So what if you need to invest more than that? So, you've got in the wealth creation strategy, the business is doing well. Where do you then put money if you've maxed your ISA, you've maxed your pension? Well, then you come on to this family investment company. And again, I've done a video on this. The family investment company is basically using a limited company to hold investments. So you hold investments in stocks and shares, in residential property, commercial property, all sorts of assets, but you choose to have them in a limited company as opposed to owning them as individuals or jointly as husband and wife, because the tax regime is more favorable if you hold those assets in a limited company. So in a nutshell, that is the investment strategy, the wealth creation strategy for husband and wife who have their own business. Max out the ISA every year, max out the pension, and then have a family investment company, particularly if you're going to sell the business and all the proceeds can be parked tax-free in a family investment company. Done a separate video on that. So what about, again, husband and wife, but assuming this time they don't have their own company, they're not direct shareholders of a company, but they are higher rate earners, they have good salaries, they work for someone else, but they've got well-paid salaries. So how does that change the wealth creation strategy? Well, it's pretty similar, but there are some subtle differences. So in this case, again, you would choose to try and max the ISA. Whenever you can, max your ISA, 20 grand a year each. So 2 lots of 20 grand for the husband and wife. Now, when it comes to pensions, again, the pension rules say that you can have 40 grand a year each from all sources and also this £1 million lifetime allowance. But in this case, unlike with the husband and wife in the limited company where the corporation tax was the bigger tax problem, so we did it through the company, was individuals, the tax problem shifts because they've got high salaries. So they have got income tax, big income tax bills. So they would do a personal pension contribution, unlike husband and wife here doing a corporate pension contribution. The couple here would do individual pension contributions. It all goes to the same pot, i.e. the individual's pensions pot, but it's just sourced from a different place. So this time it's sourced from them as individuals. And the tax rules are that you get income tax relief as opposed to corporation tax relief. So income tax relief on 2 lots of 40 grand a year. Now, how it works from an income tax planning point of view, when you put into a pension, what happens is you get 2 bites at the tax relief cherry. The first is that it extends your basic rate band, meaning that you are a basic rate taxpayer for that much longer based on the size of your pension contribution. So the rate at which you start paying 40% tax is delayed by the value of the pension contribution. So you pay more of your income at 20% instead of 40%. So your tax bill has gone from 40 to 20, that's a 20% saving. That's stage 1. Stage 2, the government also top up the cash in your pension pot for another 20%. So money goes in to your pension, you're claiming tax relief on your tax return, and also the government wire in 20% to your pension. 20% relief via the tax return, 20% relief via the pension pot combines to give 40% relief. So that's the wealth creation strategy for husband and wife who are big earners, salary-wise, working for other people. Important difference to the pension contributions via husband and wife who have their own business, but ultimately it gets them to the same stage. It's just a difference in the treatment of the tax relief on the way in, on the contributions to get there. Again, on this one, a family investment company, if they've exceeded the 2 million lifetime allowance between them and they've maxed out all their ISAs, then the next thing is to start looking at assets in a family investment company and make use of that. But basically that's the scenario, what I label a wealth creation strategy. If you are looking to invest, as everybody is, everybody needs to put money away for retirement, for the future. But in terms of how do you do it, that is how you would do it. Max out your ISA, max out your pension, then start to think about limited company. Then of course, once you've got these, the next question is, well, once you're in the ISA, where do you put your money? Well, that's where you speak to a financial advisor who can advise on stocks and shares or government bonds, all sorts of things. So within each of these wrappers, there is a whole range of investments that you can invest in. The tax relief and the tax rules are the same regardless of the types of investments. So if you've got an ISA and you've maxed it out, 20 grand a year, you get the same tax-free growth if it's all in one share on the NASDAQ or you're in a fund of shares spread over the global equity index. Doesn't matter. What happens is the increase in the fund and the yields, all tax-free. So it's the nature of the wrapper which affords the tax treatment as opposed to the underlying investments within that wrapper. But yes, that's the strategy, ISA, pension and family investment company. So if you like this video, please do subscribe right about there. And as always, I'll see you soon.